Joining us now to break down all the market action is David Zervos, Jefferies chief market strategist. We really wanted to talk to you after yesterday, David, because you have been bullish on stocks, and it sounds like you still are, despite some potentially worrisome signals from the bond and currency markets that have spooked investors lately.
I think that's definitely a fair characterization, Sarah. I think there's some positioning misalignments, particularly in the fixed income markets. A lot of people in Q1 put on these big inflation bets. We had one of the worst quarters for fixed income total return in the long end in the history of the Lehman Ag. So it was a big positioning move, and I think a lot of people have started to question that inflation scenario, and the inflationista crowd is going to get tested, even with the amazing inflation data on the high side. And we can talk about that a little more. I think what we're seeing in energy, what we're seeing in a lot of other parts in some of the commodity spaces is really starting to give people a forward-looking view that this inflation story is very much transitory. And when you break the CPI up and you look at just, say, the median CPI or the trim mean CPI, it's very much easy to tell this transitory story. And I think that's weighing on the bond market. Yields go lower, and then the equity market doesn't know how to react to that sometimes. So it thinks it's supposed to, and then it realizes it shouldn't.
So you're saying, David, you think yields stay lower and that ultimately that's good for equities? They just haven't necessarily responded in full yet? Responded a bit today, of course.
Yeah, certainly. Look, lower real yields in particular are very good for equities from a valuation perspective. But I don't necessarily have a strong view that we have not had a big call on rates this year. We don't. My call has really been purely an equity call, which is unusual for me. But I'm okay if rates tend to dip back up a little bit. I just think you had a really, really skewed position to start the year. I mean, we had, a 90 basis point sell-off in the first quarter and the long end. And I think people got very excited about this. The Fed's going to make a mistake, and we're going back to the 70s. And they just got overzealous. And this might be a swing that went too far the other way, down to 118 or 115 yesterday in 10-year yields. And we could snap back. But this idea that we're gonna have some big inflation mistake is, obviously something I've been on here talking with you guys about for a long time, is I think a really bad idea.
Over the summer months, what's more likely? S&P 500 5% higher or lower?
Higher.
With what level of conviction?
I've probably upgraded slightly my view on the way this year is going to end. I was sort of more in a 20% year camp, and obviously we're at 16 now. We've done that a little bit more today, the total return. We've done that pretty quickly in 6.5 months. That's an over 30% run rate, probably almost 35% run rate. So I think the odds are very high. We end up somewhere between 20 and 25 and closer to 25. And I would even add some mass to the distribution that we have a 30% year. And I really wouldn't have done that at the beginning of the year. I wouldn't have had sort of any probability up there. I think the Fed has done a great job at backstopping this. I think they will do if we have any further problems, if the COVID stories pick up again, and the closures and the masks come back. Mm-hmm. And I think they're going to get off the hook with this inflation story. And we've talked about it before, too, after employment reports. I'm kind of in this camp that we don't need to hire back as many people, that we have a big productivity story that comes out of COVID. And so it's going to be slower to get these jobs back than a lot of people thought. All that adds up to me.
Good to see you. Thanks so much for joining us.
Shepard Smith here. Thanks for watching CNBC on YouTube.